As you plan for the future, selecting the right investments can make all the difference. You want to see your investments grow in value to meet your future financial needs, but you also want to control the amount of risk you take to limit potential losses. As the financial markets evolve, it is also important to be able to adapt your investments to the changing market conditions on a timely basis. We realize these goals can be difficult to achieve, and that is why Barclays has developed a multi-asset class dynamic index called the Barclays Trailblazer Sectors 5 Index, or Trailblazer. Trailblazer aims to track a diversified portfolio of assets with the highest return potential for a given level of risk. Additionally, Trailblazer is designed to have the ability to change its portfolio as often as daily to adapt to shifting market conditions. How does Trailblazer achieve this? To control risk, the index aims to limit its annual volatility to a 5% target level. To maximize return, Trailblazer uses a set of predefined rules to find an optimal portfolio that is expected to provide the highest return potential, subject to the 5% volatility target. The index is dynamically rebalanced into the new optimal portfolio each time certain trigger conditions are met, as frequently as daily. Now let's take a closer look at the building blocks that make up the Trailblazer portfolio. Stock ETFs, which provide exposure to companies in specific sectors of the US equity markets. Bond ETFs, which provide exposure to long-dated US Treasury bonds, mortgage-backed securities, and high-yield US corporate bonds. And a cash position. Trailblazer utilizes 13 ETFs that provide a diversified exposure to the stock and bond markets, plus a cash component. The ETFs are the growth engines of the portfolio and provide the potential for earning returns. However, since stocks and bonds carry risks, so do the ETFs. On the other hand, cash carries no investment risk and does not earn returns. This comparison exemplifies a trade-off that is often faced by investors. Namely, higher risk tends to be associated with higher return potential, and lower risk with lower return potential. The trade-off between risk and return is the principle that Trailblazer relies on to find the optimal portfolio. Here is how. On each trading day, Trailblazer looks at every possible combination of its underlying assets. To allow for optimal results, Trailblazer does not impose any restrictive caps or floors on the weight of any underlying asset. First, the index calculates the volatility of every portfolio combination based on how volatile each component has been and how the components have moved relative to each other. Then, the index eliminates all the combinations whose volatility exceeds the 5% target level. The index then selects the combination that has the highest return potential by picking the combination of assets with the highest weighted average volatility. In other words, based on the trade-off between risk and return, the index assumes that there is a direct relationship between how volatile an asset has been in the past and how high its return potential can be going forward. This combination will be Trailblazer's optimal portfolio for that day. As market conditions change, the optimal portfolio is also likely to change from day to day. How and when does Trailblazer rebalance its portfolio to adapt to these changes? Rather than following a rigid monthly or quarterly schedule, Trailblazer determines at the end of each trading day whether it needs to rebalance the portfolio. A rebalancing will be triggered only if any of these three conditions are met. Volatility of the current portfolio exceeds the 5% target level by more than 1 percentage point. Volatility of any of the underlying assets has changed by more than 5 percentage points since the last rebalancing. There is a difference of 10 percentage points or more in the total weight allocated to equities or fixed income between the current portfolio and the newly identified optimal portfolio. If a rebalance has been triggered, Trailblazer will adjust its portfolio to match the new optimal portfolio for that day, subject to certain weighting constraints. The rebalance will occur on the following trading day. This dynamic rebalancing approach avoids unnecessary adjustments to the portfolio when the market is stable, but also allows the index to rebalance as frequently as daily when market conditions are volatile. In addition to dynamically rebalancing the portfolio, Trailblazer also has a daily volatility control mechanism in order to track the 5% volatility target more closely. The index will increase or decrease its level of exposure to the portfolio, subject to a minimum of 0 and a maximum of 150%, if the portfolio's actual volatility deviates from the target level of 5%. The more volatile the portfolio has been, the lower the exposure level tends to be, and vice versa. So, in summary, Trailblazer tracks a dynamic portfolio that can provide exposure to a diversified range of stocks, bonds, and cash. It follows a rules-based strategy that aims to optimize the index's return potential within a risk limit of 5% volatility per year. It looks for an optimal portfolio on every trading day in order to determine whether a portfolio rebalance is necessary. The portfolio is only rebalanced if at least one of the specific trigger conditions is met. This is intended to avoid unnecessary adjustments in calmer markets, while allowing the index to adapt to market changes quickly in more volatile markets. The index also dynamically adjusts its exposure to the portfolio up or down in an attempt to maintain the 5% volatility target. The Trailblazer strategy involves fees, costs, and certain risks, and you should consult with professional advisors before making any investment that is based on the performance of Trailblazer.